Hello and good morning, and welcome to the Global Business Update, where I bring insights on main business stories, global markets, and the latest macroeconomic data releases as they come out. Today, we'll be looking at Gartner's projections for information technology spend in 2024. The projections are lower than what we had initially expected. We'll be talking about those trimmed projections. Intel's also wins in the European Union court over a $1.15 billion fine dispute. And then, of course, more cuts in headcount in Citigroup. We'll talk about that, and Shell. And we'll also relate that to what's going on in oil markets. The International Energy Agency released a report today saying crude demand growth much lower than expected, down by half actually in 2024. The Red Sea chaos continues to snarl global supply chains, and we'll talk about that as well as the outlook for inflation, the latest from the IMF on that, as well as November industrial production for Japan, which dipped by 1.4% year on year, and what to expect. And we'll also mention briefly some of the things going on at Davos. Gartner trimmed their projection for IT spend in 2024, and they revised downwards their outlook for growth in IT spending, predicting a minimal impact from the much hyped emergence of generative artificial intelligence software. All this despite the growing interest in AI by almost every player in the technology sector. Gartner now says worldwide spend on information technology is going to increase 6.8% this year, down from a previous forecast for 8% growth. Gartner is bucking the trend in these predictions, given that many others are saying we're going to see much stronger growth. But we'll wait and see what happens. Generative AI won't significantly change the growth of IT spending in the near term, according to them. And they also add that IT managers are suffering already from the change fatigue. Gartner adds that it expects strong growth in IT services, but this will come from organizational efficiency and optimization projects rather than from greater usage of AI. Let's wait and see. Already many analysts are looking beyond the initial hype and asking, so what? As investors increasingly interrogate the fundamentals and scrutinize intensely for clearer evidence of commercial viability. This is as many consultants warn that most companies are yet to be well prepared in terms of their data and the various change readiness factors. Still in 2024, AI-related stocks are not losing any steam. Nvidia has already seen over 17% growth in share price year to date, and the first month has not ended. Even if the data begins to point to less growth in artificial intelligence assimilation than expected, Q1 should still be strong for AI-powered stocks. My suspicion is that we will see a moderation in that growth in subsequent quarters as some of the expectations tend to disappoint and markets price in less of forward-looking potential and look more at the fundamentals, like I said, and that could drive a rotation to value stocks. As we speak, if you look at Nvidia shares, closed down 0.58% yesterday. Their shares in pre-markets are up 2.29%. So clearly markets are not pessimistic about the outlook as much as Gartner would like us to believe. In 2024, regulators are going to be more awake than ever, and semiconductor, AI, and big tech players are on their radar for sure. Intel Core was able to overturn a one-time record antitrust fine of $1.15 billion at the EU court. Justice Advocate General Laila Medina said that regulators' attempt to reverse Intel's victory in the lower court should fail because they didn't show the company abused their dominance in the market for PC chips to frustrate rivals. But my sense is that regulators are learning and getting smarter in their legal pitch. It's almost certain that they will be back as 2024 gets set to be a year where big tech comes under much more scrutiny than they have ever seen. as issues like fairness, competition, privacy, consumer protection take a center stage. Looking at Intel shares, the shares closed down 2.12%. That was at close yesterday. In pre-market, the shares are up 1.41% as we speak. Citigroup yesterday reported that they are planning to lay off around 20 equity researchers in the Asia Pacific as part of their overhaul. Though a small dent, if you look at the regional research space, more cuts are expected in Japan, in Australia, and Korea. And as we hear, an ongoing sweeping reorganization could lead to as many as 20,000 jobs being cut over the next 2 years, even as the bank continues to trim the fat. Improved returns and are not expected in terms of what they're targeting until after 3 years from now. And analysts are still at a loss in projecting what the reorganization in Citigroup is going to deliver. More investments in reengineering and its growth initiative could also mean room for negative surprises on expenses and higher near-term restructuring costs. On the other hand, Citigroup stocks have been flat for over a year and considered cheap, presently trading at far less than tangible book value. Many will be betting that even as it simplifies the business and sell off non-core units, freeing up capital and de-risking the business model, that will also translate to future capital value. Citigroup shares closed down yesterday 0.9% in US markets. In pre-markets, as we speak, their shares are up 0.27%. Still on job cuts, Shell continues to reduce headcount. Now they're starting with the low carbon solutions unit, among the first to be eliminated. Staff were given details this week, and the spokesperson for Shell said they aim to create more value with less emissions by focusing on performance, discipline, and simplification. And of course, which will require portfolio high grading, new efficiencies, and a leaner organization. If you look at Shell shares up 0.06%, pretty flat, it would seem that the oil giants like Shell are proactively preparing for a tougher 2024, as oil prices do not look like they're going up anytime soon. The International Energy Agency growth just released an outlook update that sees demand halving in sharp contrast to OPEC's forecast that came out just a day ago, showing a flat demand growth in 2024. They also add that extra supply will more likely tip the oil market into a substantial surplus. This, of course, is due to some of the factors we are familiar with: fading rebound in China's economy, tepid growth in major economies, and accelerated take-up of electric vehicles. So the IEA, they are predicting demand growth slowing to 1.2 million barrels per day this year, compared to 2.3 million barrels per day in 2023. Also, as producers outside the OPEC, including Brazil, boost their supply by about 1.5 million barrels per day to new record levels in the near term. If you look at the price of Brent crude, the Brent crude standard has been zigzagging between $75 and under $80 for the last 8 months, despite a considerable risk premium. I can see as we speak, shares, Brent crude is down 0.04%, $77.85. And that, if you take off the risk premium that would be there, then the prices really should be somewhere maybe even under $75. So I think this lends credibility to the view that prices can still be considerably lower. And just yesterday, Saudi Aramco said they were beefing up their global venture capital arm with a $4 billion cash injection as they push to diversify out of the oil space. So, of course, if Saudi Arabia is going out of oil, you know what that means. EVI, we see oil prices remaining flat in the first quarter and a downward slope to under $75 on average for the rest of the year, barring major surprises in the geopolitics, which we can't rule out. Pepco, the owner of the Poundland retail chain, is warning in a trading update that we got today that disruption in the Red Sea is already leading to higher freight costs and that could hit product supply. Already freight costs were contracted until the end of the third quarter, but there are additional surcharges that, of course, is making shipping much more expensive, especially due to the longer shipping routes. It also warns that though there is limited impact on product availability currently, a prolonged situation will impact supply in the coming months. More importantly, this will feed into more stickiness in inflation and stoke more hawkishness from the central banks. Even as the latest inflation data is already suggesting caution, UK CPI just out rose to 4% from 3.9% in November, causing investors to see a lower chance of a reduction by the Bank of England from 5.25% to 5% in May. But still on inflation, today the IMF First Deputy Managing Director Gita Gopinath, she said central banks need to move cautiously on cutting interest rates this year, adding that inflation will decline less sharply than last year due to tight labor markets and higher services inflation in the US and Euro area. She says that based on the data that they are seeing, rate cuts will be more in the second half, not in the first. Finally, on global economic data, today is somewhat quiet. Earlier in the morning, we got for Japan the industrial production released by the Japanese Ministry of Economy, Trade and Industry that measures outputs of Japan's factories and mines. Industrial production was down by 1.4% in November of 2023 over the same month in the previous year. This was a major dip from 5.3% year-on-year drop seen in October. So far, most of the data of late from Japan pointed to a slowing momentum toward the end of last year, even as the Bank of Japan is hoping that improving sentiment will have a more positive impact as we begin to see the numbers reflecting economic activity at the beginning of the year. Later today, we will get from the US the latest print on initial jobless claims, housing starts, and building permits. But we can't end without talking about the World Economic Forum at Davos, where today JP Morgan Chase CEO said very powerful forces, quote unquote, will affect the US economy in 2024 and 2025, also adding that he remains very cautious. Factors to consider, according to him, will include the war in Ukraine, the conflict in Israel, and tensions in the Red Sea, even as the Federal Reserve monetary interventions is also a factor, as well, of course, as the unpredictable situation with the politics and the uncertainty of a Trump presidency. All that was at an interview today at the World Economic Forum in Davos. As we speak, US stock markets are said to be priced close to perfection, with a March rate cut still priced in. Maybe that could be the first scenario to fall apart. And that's it from Global Business Update. This is Bode Oshosami from London.